Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hahn of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon, with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is 1970s sitcoms. And I think we're all old enough to remember those. All right. Our special guest today is Matthew Burke of Fairway America. Matthew, welcome. You go by Matt, though, don't you?
Yeah, Matt's fine.
Matt. Okay, Matt, welcome to The Best of Investing.
Yeah.
All right. Mark, take it away. I know you got a bunch of questions you want to ask Matt.
So I'm particularly excited to have Matt as a guest today because 10 years ago this quarter, Matt was helping us at Pacific Private Money design and launch our first private placement. Since then, we are now on our 7th private placement, but really the foundation of the learning and the architecture and the structure and how to raise money in a fund, that learning really came from Matt and his then partner, Lance. And I really, really appreciate and think very highly of you, Matt, and what you've contributed and how many people you've helped in the industry. You were the catalyst for, I believe, literally hundreds of private placements nationwide. And now one of your primary companies is doing fund administration as well as fundraising and promotion for private placements. And as we've talked about here on The Best of Investing, we think in the alternative investment space, private placements present some of the best opportunities for investors out there today, particularly if you're concerned about stock market volatility or where crypto is, or maybe even the price of real estate. You're still waiting for it to come down. Where are investors today putting their money?
And even gold and silver, because everyone talks about, inflation protection, gold and silver.
Yeah.
Gold and silver hasn't done anything.
But tell us a little bit about share with the audience a little bit of your background, the birth of Fairway America, and what you're working on today in the private placement world.
Sure. Well, thank you, Mark. I appreciate it. I've run Fairway for just celebrated our 30th year anniversary back in September. So hard to believe. It's been 30 years, and in that time frame, went from being a mortgage broker doing residential loans to doing private investor notes back starting in the late 90s, and did a lot of matching up deals, one deal at a time, one investor at a time for several years. Launched our first fund back in 2000, 1999, 2000. And I think that process, Mark, really showed me how inefficient it was to hire a lawyer and try to figure out how to do it. And I made all the mistakes, right? Made as many mistakes as you could make, but learned a lot along the way. Did another fund and ended up, by the time the Great Recession hit in 2008, we were on our 4th fund. Had a large credit facility, $50 million at that time with that fund. And coming out of the backside of the downturn, they wouldn't renew that line. So I learned what it was like to wind a fund down. And I think coming out the other side of the Great Recession, I had a lot of people asking me my opinion about running a fund, setting it up, what it was like, et cetera. And as we were coming out of winding that fund down, we decided, hey, there's a lot of people that really need that help. So we started doing a lot of advisory work for other managers around the country who were interested in setting up their own pooled investment fund. So we came at it from a fund manager position as opposed to a legal position. Obviously, legal is important, have to comply with securities law. You have to make sure you do all, follow all the rules and cover all your bases. But I found for most people, Mark, that wasn't really the issue. The issue was, how do I originate, raise capital, manage assets, deal with the accounting and the legal, and because they all influences everything else. And that took off and went quite well. We ended up starting an administration business to do the back office work after the funds got launched, and that business has since split off from Fairway. It started off as Redwood Real Estate Administration. We rebranded it. It's now called Verivest, and that company has grown as well. And so, it's been a journey, but I would say that our expertise really lies in setting up these funds, non-institutional or sub-institutional size real estate and mortgage pool funds for people who've been doing it one deal at a time, helping them make that leap and helping them be successful. That's really what we've done for the better part of the last 10 years.
And you've also, as you mentioned, you did your own funds. What fund number is Fairway up to these days?
I think we're on our 11th or 12th fund now, and not all of them have been the same. The first 4 or 5 were mortgage pool funds. We've done some, I'll call them mixed bag funds, where you have both equity and debt. We've done some GP co-invest funds where we partner up with specific people for the GP slug of equity for real estate deals. So it's been a variety of things, but we're going on our 11th or 12th fund at this point.
Okay, Matt, stay with us. We're going to cut to our first commercial break. And when we come back, we have a lot of great questions and topics to cover: the do's and don'ts, mistakes, misconceptions, challenges, opportunities, etc. All right, here's our first trivia question on 1970s sitcoms. What were you watching if you hear "Kiss My Grits" spoken by a waitress named Flo? Actually, I never cared for this show, but call 888-912-1190. First caller with the correct answer wins that tanning certificate, which, by the way, is worth over $100. So it's a nice gift. Again, 1970s sitcom. What were you watching if you hear "Kiss My Grits" spoken by a waitress named Flo? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my co-host, Mark Hanf of Pacific Private Money. Our first trivia question: what 1970s sitcom were you watching if you hear "Kiss My Grits" spoken by a waitress named Flo? What was the name of that show?
I remember it, but I don't remember the name. I remember the tagline.
Matt, do you remember?
Alice?
Alice, that's right. Came from Alice Doesn't Live Here Anymore, I think. Something like that. Okay, so we are in the studio here with Matt Burke from Fairway America. So Matt, I want to ask you about setting up pool investment funds, the do's and don'ts, mistakes, misconceptions, challenges, opportunities, open versus closed, debt versus equity, et cetera. So why don't you kind of go through the maturation there?
Sure. Well, there's a lot of all those things, Edward.
Mm-hmm.
So, I mean, I think the first thing I would say to people is why do you want to set up a fund? I think setting up a fund is aspirational, right? So most every manager I've ever met at one point or another has thought about setting up a fund, but I would say it's not for everybody. In fact, after 10 years of this now, I'm talking to literally thousands of managers that want to set up funds. For many of them, it's probably not the best idea. So I think step one is, why do you want to do it, and make sure you're clear on the why. I think that people have a lot of beliefs about what a fund is going to be like, and many of those beliefs don't pan out. So I think trying to be honest with themselves about, what they can truly expect, and talk to other people that have done it before, so you have a very clear idea of what you're in for if you set up a fund is step one.
So for those people who you did your analysis and said, for what you want to do, a fund is not the right, what were the reasons, and then what did you recommend to them?
Well, most of the time I recommend them to continue to do deals one at a time. I think it's easier to raise money, generally speaking, one deal at a time, especially in the beginning, because investors know exactly what they're investing into. So when they come into a fund, they're investing in an idea or a concept or a strategy, but the assets are not identified, right? So people who want to know specifically what the assets are, it's not for them. I think that velocity is important. I mean, this is why mortgage pool funds, especially short-term bridge loans, tend to be a good structure for a fund, because there's a lot of activity going on. If you have an origination capacity to do quite a number of loans, and those loans cycle out pretty quickly, capital's always coming back into the fund. You don't have to raise as much money as if you're investing in things that you're holding on to for 5 or 10 years, right? Because the money doesn't come back, you can't recycle it. So the origination capacity of the manager and the velocity of the assets is a very important factor in whether or not it makes sense to.
Yeah, no, that totally makes sense. I mean, I can see where, it would not make sense to do these one-off deals. We do all this paperwork. If you're going to do a short-term bridge loan, it's going to last 3 months.
Yeah. So there are, and then I'd say understanding where and how you're going to raise the capital is an important part of running a fund. And I think a lot of people don't really know. I mean, I've heard, I can't tell you guys how many times I've heard people say this, but when I ask them, why do you want to set up a fund? They'll say, well, because I want to have the money sitting there when I go out and make the offer on the property, or when I go to do the deal. It helps me, be able to get my, get the deals tied up more easily. Like, and then my next question is, well, what makes you think that just because you set up a fund that the money will be sitting there?
Yeah.
I mean,
Well, and that's exactly right. I think the fallacy of the fund, and I meet a lot of these people too, who when they learn that I've set up multiple funds, they look for advice and recommendations, and what you're referring to is a blind pool fund. And blind pool funds are not popular among investors. I mean, if you're looking to raise millions of dollars and you're hoping to get big check writers, people writing, $100,000, $200,000, $500,000 checks, which are the investors that we tend to serve, they're sharp. They probably have invested in private placements before, and they don't want to invest in blind pools. And a blind pool is basically, as you described, it's like, well, I'm going to go out and raise a bunch of money, then I'm going to go out and buy real estate. Well, real estate syndications is a great way to make money and to help investors, earn, real estate type, high double-digit yields. But it's kind of the cat and mouse game, or the cart before the horse. It's you almost need to, you kind of have the conversations with the prospective investors, line them up, get, what's called soft commitments. Yeah, I'd have an interest if you found something good. And then you got to go bird dog, good deals that you could potentially get in contract. It very much is a chicken and an egg process if you're going to do real estate investment type syndications. But there are a lot of people out there who are doing it quite successfully. And the hardest part is getting that first one done. Right?
Yeah. Well, and what happens there, Mark, is that if somebody has something under contract, right, it's easier to get people to say yes to a deal where they know exactly what property they're putting their money into. But people have hard deadlines, right? You put the money up, you've got earnest money, you've got a 60-day close, you have a finite period of time to raise that money. And for the managers putting up their own money generally to tie the property up, there's a lot of pressure to get that money raised in a short period of time. So the fantasy is, well, if I had a fund, I'd have all the commitments up in front in advance, and I'd know I have the money, which gives me more confidence when I'm going in and tying up the property. But what they don't put two and two together on is that just because you create the fund doesn't automatically mean that you've got a bunch of commitments sitting there. You got to go get commitments from investors who are pledging to give you money subject to deals they don't even know anything about. That is a super high bar. It's a higher bar than a syndication, and a lot of people underestimate the difficulty of doing it.
Well, here's the other part of it, is that if you're trying to explain why you're going to give them such a great rate of return, you can't have money sitting idle for months while you're trying to find that deal. Because the people, that's when they're putting their money up, they're expecting their rate of return to start the day that they.
Yeah. And then of course, which gets into a lot of specifics around, how do you take the money in without committing, without the pref starting to tick. And like, there's so many things that people, I use this analogy all the time and on multiple podcasts and, things I've done, but it's a lot like having children. You don't really know what it's like to have kids until you've had them. I mean, you can babysit all you want, your nephew and your niece, and you can read parenting books and you can go to like classes and such, but you really don't know for sure what it's like until you have kids. That's what it's like running a fund, right? You just can't know until you're in the middle of it.
Yeah. Agreed.
All right, guys, we come back. We do, at some point, we're going to hit an email that we received from Mark that says, how often do you raise or lower your interest rates to your borrowers and your lenders in your fund? All right, our second trivia question has to do, again, with 1970s sitcom. In 2021, this show was in its 47th season, but it started in 1975. Yeah, that makes sense. When Chevy Chase was with them. What TV sitcom are we talking about? It's actually, technically, it's not a sitcom, I wouldn't consider, but it was a 1970s show.
That's a softball. I think so.
Yeah, I know the answer. Okay, 888-912-1190. First caller with correct answer wins that tanning certificate. Stay with us. Best Investing. We'll be right back. Welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money, our special guest, Matt Burke. Our trivia question number 2 in 2021. This show was in its 47th season. Started in 1975, and Chevy Chase was one of the originals. What's the name of the show?
That's Saturday Night Live.
Saturday Night Live. All right.
That was a softball. That was too easy.
That one was a little too easy. Okay. Want to make a quick mention here for the Mount View Hotel and Spa in Calistoga. They're offering 25% off all rooms this season. Check them out at mountviewhotel.com. All right. Actually, the next trivia question we have is going to be even easier. You'll like it.
Okay, all right. Another question for Matt. So we've been talking about the structure side, the sponsor side of putting a fund together. Let's look at pivot over to the investor side of it. I'm a big proponent to investors to look at private placements and as part of their alternative investment portfolio. Of the funds that you have you're self-sponsored and you've helped with others and you're administering, do you have a favorite type of private placement that you think most investors should be looking at?
I wouldn't say I have a favorite, Mark. I think that it depends on, as always, the objectives of the investors, right? So if somebody's looking for predictable, reliable cash flow versus are they looking for tax advantages or significant growth, it really varies depending on the type of investor. But I'd say for cash flow oriented vehicles, debt is almost always better than equity, in my opinion, because they're coupons, they're interest rates. And if you got a good underwriter, a good manager that knows what they're doing, that knows how to underwrite, they should reliably be able to produce decent real-time income returns. If you start investing in direct real estate ownership, even if you think there's going to be cash flow, a lot of times there may not be because expenses are too high, or you have unexpected capital expenditures that you might have to deal with or whatever. So equity, if you're looking for tax advantages, equity is definitely better, right? Because debt is always going to be, ordinary income, right? So it really depends on what the investor's after as to which one is the best. I would tell you the number one piece of advice I give to people is, bet on the jockey first. Right. Pick the right manager, regardless of whether you're investing in debt or equity, know what your objectives are, and then you can narrow it down from there.
Well, that's why we like at Pacific Private Money doing debt funds, because we like being the bank. And as Mr. Wonderful says on Shark Tank, we like cash flow. And here's the other thing is that, when you're doing loans and you're getting good interest rates, you're in at, 50, 60, maybe 70 cents on the dollar. So if anything goes a little topsy-turvy, then you can end up owning the real estate for a lot less than retail.
Yeah. And I've found, I've done a lot of loans over the years, Edward, as you guys know, and I'd say very, very rarely have I ever hit a home run on a property I had to take back in foreclosure. Usually there's a reason why that's happening, right? Your main point is like you've got collateral. So if somebody stops paying, if you've done your job halfway decent, you should never completely lose your capital, right, in a debt investment, but you're also super unlikely to hit home runs by foreclosing and taking property back that's worth vastly more than your loan amount, at least in my experience.
Yeah, I spent a lot of time talking with investors, and what I describe in terms of why alts, why private placements, why should they consider investing a portion of their savings in an alternative investment or private placement, and I say, well, if you understand or you believe real estate is one of the biggest and most successful wealth building tools in our generation and even our previous generations, and yet you're a little bit hesitant right now because we kind of hit the top of the market, and it looks like last year we hit it and real estate's gone down. But you understand real estate, and you appreciate the integrity of real estate and the stability of real estate in general. Real estate debt is something you should really look at. And so for funds that like some of the ones that we operate, if funds that make bridge loans, short-term loans, as opposed to long-term loans. I love short-term loans. That's our favorite vehicle here at Pacific Private Money. We love making consumer bridge loans. We like making commercial bridge loans. We do ground-up construction. Those are a little bit longer term. They can tend to be 18 months, but in a short-term viewpoint, let's just say 12 months, real estate just doesn't move that quickly. And it's funny how in our brains and in conversations and in articles, there's always the reference to the real estate crash in 2008. Well, I was doing hard money loans in 2007, 2008, 2009, and 2010. And during that 4-year period, generally prices were going down. And yes, in some markets, it dropped as much as 50% from valuations that probably weren't even real to begin with. But it happened over an extended period of time. And I never lost a dollar of principal on any of the loans that we made in my career back then in 7, 8, and 9. So, you can still make smart loans to real estate entrepreneurs who are taking advantage of market conditions. I've heard many people say there's no such thing as a bad real estate market. It's just there's different opportunities depending on which way the market's going, even in a flat market or a declining market. In declining markets, the real estate entrepreneurs come forward. We'll talk more about that when we come back.
Yeah. We also want to talk a little bit about the current market environment. Want to hear your take on that.
Yeah.
All right. And when we come back, also I want to ask Mark his email question. All right. Our third trivia question. We're talking 1970 sitcom. This actually was a 1970 sitcom. Meathead, Dingbat, and Stifle Yourself are associated with what show? Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. Again, Meathead, Dingbat, and Stifle Yourself are associated with what show? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. We got one more segment after this. I'm Edward Brown along with Mark Hunt, our special guest, Matt Burke. All right, third trivia question. Meathead, Dingbat, and Stifle Yourself are associated with what TV show?
Matt knows that.
All in the Family.
All in the Family. Very good. All right, you guys are 2 for 3. All right. So Matt, let's get into this current market environment. The impact of interest rates, increase in interest rates, and challenges and opportunities in the market, and the impact on various types of asset and classes.
Yeah, well, I mean, obviously the very, very rapid increase in interest rates throws kind of the capital markets for a loop. So you've seen volume dry up significantly in real estate acquisitions. I think the depends on what asset type you're in, but for the most part, volume has dropped off a cliff as far as real estate transactions go. I think lenders are having kind of a heyday now because they were battling low interest rates for years, and now if you're a private lender and the prime's at what was it at 7 or 7.5 now, haven't seen those days since like the early mid 90s, right? So it's an interesting time. I think fundamentally the economy is a lot stronger than it was back in the Great Recession. So I don't think that it's not a bank health issue the way it was back in the day when lenders got crazy, carried away with subprime loans to people that had no prayer of paying them back, right? And then securitizing them en masse and causing systemic financial issues. I don't think it's that, but I do think that if the Fed keeps the interest rates high and keeps raising them, it's going to cause some pain for some people for some period of time until the market stabilizes.
One interesting thing too, difference is that now a lot of people have a fair amount of equity in their properties compared to back in 2008. There wasn't as much. So, it was a little easier for them to walk away.
Yeah, I think that's fair. Go ahead, Mark.
Yeah, there's a number of reasons why we're not going to see the same kind of real estate, market downturn that we saw in 2008. And one of them is that very reason. You've got the highest amount of homeowner equity ever. They're not sitting on, even the people that bought a home, at the height of the market last year, they're likely sitting at a very low interest rate. So you've got most people who could refi, did refi, and you still got an inventory issue. So you just don't have the metrics that would support a crash bros, as some of those people are referred to, who are, filling our news feeds with dire warnings of real estate crashes. Those are really self-serving, reports. They're not even really news.
I mean, if you think about it, if someone had, like, okay, I'm a good example, right? I refinanced at a really, really low interest rate. If I sell my house and I go buy another house, unless I'm going to pay all cash for it, the interest rate's going to kill me. So I'm not going to move. And there are a lot
well,
of
that
people like
fundamentally depresses the value of the property, at least for some time period, right? So
Yeah.
it's a crazy kind of an environment at the moment. I do think, to your point earlier, Mark, there are opportunities in every market, right? They just look a little bit different. They come in a different wrapper depending on what's going on in the market. So I think there are still some very attractive and unique investment opportunities out there. They're just different than they were 2 or 3 years ago.
Well,
So-
as a lender, so we're in the private lending business, been doing this for 15 years. And what changes is not the demand, but the nature of the demand. And what I mean by that is we have loan requests coming at our ears. We can't come close to funding the number of loans we'd like to. In fact, if anything, we're raising capital in our funds. And one of the things that we're seeing with a lot of our potential investors is some of them are, kind of sitting on the sidelines right now. They're kind of in a wait and see approach, which we understand, and we believe a lot of those guys will be coming back to look at what we have and others have to offer pretty soon. But generally, like a year ago, long-term rental was a big deal before interest rates spiked up. Today, we're seeing a lot of infill ground-up construction loans, a lot of construction completion loans where they ran out of money from their bank financing because the price of materials went up. We're seeing a lot of bridge where they need to pay off the construction loan, but it's not quite ready to sell yet. So we do a lot of 6-month bridge. So it's just, and the consumer bridge still is as popular as ever. While albeit we did have fewer transactions in the last quarter, we see that picking up again.
I do want to make a quick point. Mark, you mentioned about how a lot of people sitting on the sidelines trying to wait for their next investment, which is a perfect feeder to your Freedom Fund, because there's no hold. They just have to give you a 30-day notice when they want their money back, and you're paying anywhere from 7 to 9+% depending upon how much money they put in. So it's a great place to park your money.
So our Freedom Fund is a private placement that has traditional operating and offering documents. And as Matt will appreciate, he well knows that all private placements do have a minimum lockup period spelled out in the offering documents. And even our Freedom Fund says that, you promise to keep the money in for 12 months. The difference with the Freedom Fund is we don't have a penalty for early withdrawal. We're silent on that. And so, we don't encourage people to pull their money out, but we basically tell them, look, we're going to rent your money at an interest rate dependent on the amount of money you invest. And if by chance you need it earlier than a year, give us 30 days notice, and we'll be able to process that. And that's been a hit among traditional real estate investors and others who have sold a business or sold real estate. They don't want to lock it up in a fund. They'd like to kind of keep their powder dry, so to speak. And again, it's we kind of straddle a little bit of a gray area there, but it's been a popular recipient of capital, based on the fact that, look, there's no penalty for early withdrawal, but you are going to sign an offering that says you promise to keep it in there for 12 months.
Yeah, and Matt, you've been doing this for a very long time. You've seen thousands of these. How many have you seen that have these kind of provisions in them that are paying this higher rate of return?
Well, I suspect if I read those documents, it's going to say, as Mark points out, that I'm agreeing to a 12-month lockup, right? Because that 12-month lockup is foundational to securities law and private placements, right?
Exactly.
It cannot be redeemable in less than 12 months and still be considered a private placement.
Yeah.
So I think people then have to believe that, you'll have the liquidity to be able to honor that, if they do ask for it within 30 days and not charge them something. I think a lot of that boils down to how do people feel about their ability to execute on that. And right, because at the end of the day, let's put it this way. I've seen lots of people go into deals where they thought they had something based on what the manager told them, but the documents didn't necessarily say that. And then that's great as long as it's great. And then when it's not, right? So it's relatively binary.
Yeah.
So yeah,
I mean, unfortunately, the types of loans that Pacific Private Money is doing in their Freedom Fund kind of differentiates it. And that's, I think, why they can provide the liquidity. Tell you what, stay with us. We're going to be right back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money and our special guest, Matt Burke of Fairway America. We didn't have a trivia question, but Mark, an email comes in and says, how often do you raise or lower your interest rates to your borrowers and then to your lenders? And I think they mean they're the investors.
Well, it depends on the nature of the syndication, or rather more appropriate, private placement. I've been using syndication or private placement as the same, and as Matt knows, that they're not the same. So we do private placements for our funds, and some of them are written with preferred returns and then a split of profit thereafter. Those require, generally a vote of the members to change. So it's a little bit, it's not as easy to change those. We also offer a couple of fixed rate funds that we can and do raise and lower those based on market conditions. And of course, when you lower them, you also got to give them, the opportunity to not approve that or liquidate their funds. So it's easier to raise it than it is to lower it. But we have, particularly, like for example, in our Freedom Fund, we launched it 2 years ago, offering 6%. Then we raised it to 7%. Then we raised it for based on amounts invested. So someone who invests 500,000 to $1 million, we're offering them 8%. If they offer over $1 million or deposit over $1 million, we're paying 9%. So
here's an idea. I just came up with this. Instead of the raising and lowering, what would happen if you just gave out like a one-time bonus at the end of the year? It's not guaranteed. If you just happen to say, hey, Merry Christmas. And then, because you're still back to, let's say, your fixed 8% rate. And then that way you don't have to worry about raising and lowering it. It's just like, we just decided to give you a little bonus.
There are fund accounting rules. I would have to ask my CPA whether that's kosher and whether there's any violation. Again, you have offering documents and you got to pay attention to those. You can't just necessarily be renegade on it. But many funds are responsive to interest rates, and most private placements have raised their pref or raised their fixed rate if they're a fixed rate market.
Gotcha. Mark, how do people get a hold of you if they have more questions about your funds?
PacificPrivateMoney.com. That's the best way to learn more about our offering and our family of funds. PacificPrivateMoney.com.
All right. And Matt, you got 1 minute. Tell us what you're working on now, and then give out your information.
Yeah, we're launching a new fund here pretty soon, focused on the build-to-rent space, buying single-family communities, using them as rentals. So that's something we've done a lot of. On the Verivest side, we're launching a technology product called Fund Builder that helps people automate the process of building their syndication in their fund, doing it all online. So you eliminate the back and forth with lawyers and so forth, and you still want to engage Securities Counsel, of course, but this just streamlines the process, makes it faster, simpler, easier, cheaper for people to set up syndications and pooled investment funds. And that product's scheduled to launch here in the next couple of weeks.
Wow, that's exciting.
Yeah, it is. How do people get a hold of you if they have questions about this?
Fairwayamerica.com on the Fairway side, or Verivest.com on the Verivest side.
All right, Matt, it was a pleasure having you. Now we're going to go to our thoughts for the day. Mark's favorite part of the show. All right, because we always add a little levity here. Okay, so years ago, I lost my job at the bank on my very first day. Why? Because a woman asked me to check her balance, so I pushed her over. I didn't go over too well. And did you hear about the mathematician who was afraid of negative numbers? He stops at nothing to avoid them. And lastly, do you want to hear my joke about straws? Never mind, it sucks. All right, tune in next week to the Best of Investing. We're going to be giving away more free prizes for answering trivia questions and coming up with more dad jokes, I'm sure. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.